Hey folks, it's Michael and Brianna with Wealth by Real Estate. We have a special guest today, actually one of our dear friends, works at Live Sotheby's, Live Distinct team. Delroy Gill is
Thank
here
you.
in the house. So
I'm here. Made it.
He made it. Appreciate you being here today.
Yeah, thank you for having me.
Yeah, for sure. We've known Delroy for quite some time. He's been kind of the guy that we go to for a lot of luxury real estate. He's kind of the guru here in the Denver metro market.
Big titles already. Big titles already.
You're going to have to live up to this today. So, but yeah, I mean, he's kind of our go-to for that. And, we went to lunch recently, talked about investments and what he's doing in the investment arena. As you guys know, we're big in investment real estate. We're trying to invest as much as possible for ourselves, also teaching people how to invest. So I thought it'd be a great idea for the luxury guru here in Denver to come in and chat about what you're doing in that space.
Yeah. Thanks for having me.
Yeah,
I'm an open book, like, me and Mike and Brianna went to lunch, brainstormed, talked about life and everything else in between.
Yeah.
And I've obviously seen you grow and do everything that you've done in the investment space. I've been in the luxury space running parallel, but now, I'm trying to cross over and get more knowledge. So I'm happy to be here. You're going to question me, but I might have some questions too. So this is great.
Yeah, that's awesome. So I think we have seen each other grow quite a bit. I mean, we've known each other for like 10 plus years, but we were little pups when we got started and we've actually came a long way. A lot of people get stuck kind of in the day-to-day mundane real estate transactions and, trying to feed themselves with the next paycheck. And I think, everybody in this room has grown tremendously in a short period of time where we're not having to grind every single day to feed our families. We actually have saved some money. We're actually doing a higher level of business because I think we've invested not only in ourselves, but in other things to make sure that we're comfortable.
Yep. Yeah. I mean, I started real estate in 2008, like literally, you might as well call it the day before they turned off the lights and everything started tanking.
Right.
And I had just bought my first house at that time and had to kind of build my business during the recession. Like when I got into real estate, everyone was like, "You're crazy. Don't get into real estate. It's the worst time. Do you see what's happening in the marketplace?" I had come from a marketing background, so I used to do like sales and marketing, online stuff. So using all of those tools to help me garner business, I just had to find whatever I was going to apply it to. And at that time, it was short sales. And I was just cranking out short sale transactions. And this is why today, with a lot of stuff that's happening in the world, I come from a beginning of houses sitting on the market for 6 to 12 months. That was a normal housing cycle. Like it took 6 months to sell one property because there was so much inventory. So at first, to get from point A to point B, just to start that cycle turning over, was a super grind. It was definitely a struggle. I was struggling to pay my own bills while everyone that was my client was struggling to pay their bills. So we had to kind of help each other grow through that period, but went in with like the care and intention to really fixing the problems that people had and explaining to them why they were in this situation, why they had a bad loan, so that moving forward, they wouldn't make those mistakes again. So that helped me kind of get to where I am today because those clients understood that I'm going to tell them the truth, whether it's good or bad. I'm going to tell you your loan is a messed up loan. And now when we do the next transaction, hopefully they trust me with my guidance and advice to buy their next home. So that was kind of the beginning stages.
And on that subject, because a lot of people, especially right now in this market, are saying that it's another bubble that is going to burst. And for those of you that don't know, a short sale is when you owe more than the property is worth. So you're basically upside down. And at that point, you have to decide, is it best to just foreclose or do I pay that money and get out of the property? So with that in mind, what do you think about the market today? Because it is a very different environment where people are sitting on a lot of equity. Appreciation went up significantly over the past several years. So what's your perspective on the market?
Yeah, so what you have to look at, and we can just use today, we're in Denver, so we're just going to use our local market for everyone listening, but let's say right now it's said to have like a 15% discount on the market based on where rates have gone. But buyers are still climbing up at those price points, even though there's a 15% discount because of where rates are. So yes, the market has gone down on paper, but everyone's payment that they're looking at paying right now is still significantly more. So that was a bad wait. Like, oh, I'm going to wait until prices come down. Everyone was saying, I'm going to wait because the market's going to tank. So even if, let's just say what everyone's been predicting, worst case scenario, the market comes down 30%, right? That's what people are saying. That would mean rates probably end up round about 9%, and your payment's still going to be more, even with the 30% discount. And most homeowners that have bought their house for the last 10 years are sitting on way more than 30% of equity. So the seller's still coming out on top, even if they take that haircut on that initial purchase. The buyer will end up suffering if they don't just buy. And especially if you're a home buyer and you're just buying to live in and you're not doing what we're talking about, true investing, and worrying about cash plays and cash on cash returns and all these different things, it's like, you don't have to actually worry about that. You're going to wait the market out, just like I did when I bought that first house in '08. I bought at the top of the market. My interest rate was 8%. I still own that house today, which became my first ever investment property. The house is now worth 650, let's call it 700,000. If I lose 30% on that house, I paid 220. That's how much I bought that house for. 220 grand. It's nearly paid off. I don't care if I lose 50% on the house. I'm still up no matter which way we slice and dice it. And that's what people have to remember about real estate is like the long term, if you're just a home buyer, or what is your strategy in investing? Sometimes people get a narrow mind and try and focus on like the right now market and don't have a true strategy as to how they're going to be investing.
So with that in mind, and again, I just kind of want to touch on the differences between 2008 and today, because, with sellers sitting on so much equity, they're going to be okay. There's definitely not going to be as many short sales as there were. No. The last stat I heard was 60% of Americans are sitting on over 50% equity in their home. Yeah. So even a 30% drop right now is not going to hurt them because, as we all know, the real estate market is cyclical, but in the end, it always goes up. Yep. But, from your perspective, do you see inventory, because really supply and demand is what controls the pricing and interest rates. It's a combination of both. Do you see supply increasing to a point, in 2008, there was 26,000 homes on the market in Denver. Yeah. Right now, there's 6,000 homes on the market in Denver, even in somewhat recession. Yes. So what's your perspective on that, and how are you taking advantage of it?
The supply will not reach what it didn't. It's impossible for the supply to reach what it did back in 2008. So every market will have its own opportunities, and you just need to be ready and poised for whatever presents itself. But inventory has gone up. It has gone up. It's going up, I should even say. But with that becomes just now you have to look at rate and supply. Those two are creating the opportunity. And as the supply goes up, now the seller becomes more open-minded to take that 30% haircut. Whereas right now they're like, no, I want to take a 10% haircut. And it's like, as an investor, you have to be like, let me be patient. I'll wait, because that 30% haircut is coming, and that does affect my bottom line of how I'm going to strategize and make money off of this deal. The pain in, like, if people just go out and walk around day to day right now, Starbucks is still packed, the mall is still packed, everyone is spending money right now. Like, the recession isn't happening. And it is happening. It's actually happening right now today. So the people that get smart and start planning and strategizing now will be able to reap the benefits as the supply does go up. And because the rates will come back down again. Right. So people have to just be able to cash in on a deal, refinance when they can. And now you're going to be cash flowing way better than you were if you jumped in at an earlier stage in the market.
Which is great in particular for long-term holds. Exactly. Right? So fix and flippers have to be a little bit more cautious going into it, which, we're big on fix and flipping. We're big on short-term rentals, long-term rentals. But right now is a huge opportunity that we see in particular for investors to come into the market and to make long-term purchases for rentals and short-term rentals. Because like you said, even though the interest rates are slightly high right now, you refinance, you're in a much better position even than you could have been buying a house a year or two ago.
Yeah, a lot of my clients, even the ones that have been flipping, they may have came in with projections before everything, because right now this was a rapid changeover. Like this happened in such a short period of time that I don't think anyone could predict it was going to get this aggressive, even though we knew this was coming. It just happened in such a short window. So a lot of my clients that were doing fix and flips, some of them are like, hey, 50% of my inventory, I'm just going to rent it for 2 years. Yeah. So they flipped it, put tenants in, and then 50% they cash out, even though they didn't make the big profit that they thought they were. They got some, they put some money in the bank, rent out some properties, and then keep it moving. And then they now analyze deals based on what's happening today. And I got a question for you guys, is like, how does that change in how you guys analyze deals with now rates being high? Like if I wanted to do a flip, what changed from 90 days ago to today on how you crunch those numbers?
Yeah, I can tell you right now that any properties that we're looking for currently, that we're writing for fix and flips for ourselves, it's got to be a significant discount. We're actually taking comparable properties not from this year, but actually from 2021.
Oh, wow.
So if something sold in 2021 for say 400,000 and it could have sold for 500,000 in June or May of this year, we're going back to that $400,000 number, right? Yep. So we're not even using comps from January to June for properties we're buying right now. And then also, like I don't know if you've been noticing, but if you're comparing properties that you're looking to purchase now, you've seen already a major discount from June to now. Yeah. So if a property was $500,000 in May, that thing is now selling something similar for $430,000. Yep. So I think we're, in my perspective, that's going to continue to slide through the end of the year. We may see a little bump at the beginning of the year as people come back out of the holidays and looking to get back into the market. But I think it's going to slide through the first quarter, maybe second quarter of next year.
Yeah, I was watching or listening to a YouTube video, and it's almost like the pandemic market. If you just draw a line from the beginning of the charts, whatever chart you're looking at to today, and just draw a straight line, that's actually where the market actually is. That up and down in between is all just a facade of panic and emotion and how everyone was moving at the time, but it's not really true value. So what you're doing, I like. You're just going back past it, and that's the true value. Back. I think that is
100%, and that not just with houses. That's with
everything. Yes,
cars, watches, you name it. Any asset class, it's going back to have this adjustment.
Yeah.
That's just because of inflation. Inflation went crazy. They printed a bunch of money, and now they're bringing it back down to before COVID levels. So just to touch on that though, because I'm a big analysis person. So the beauty about being an investor and being able to analyze deals is that if you know how to analyze, let's say, a fix and flip or a long-term rental or a short-term rental, if you go back to it, we kind of always run back to our fix and flip model because the fix and flip models are the most conservative. You have to have the biggest spreads on a fix and flip to do well. Usually, a $200,000, $300,000 spread because we're trying to make a 10% return on these fix and flips, but that includes the fix-up costs, the holding costs, paying commissions on the back end. So when all is said and done, you need several $100,000 spread in between that. Yep. If you can be conservative on your after repair values and analyze it for a fix and flip, you're going to be great on that deal because that's a deal. Yeah. And so then once you get that deal and get it under contract is then when we decide, okay, what should we do with this? Should we flip it? Should we sell it as a rental? Should we keep it as a rental? Should we keep it as a short-term rental? Should we wholesale it? But if you really learn how to analyze properties conservatively, especially in this market, then I think it actually opens up the door for huge opportunities for you as an investor to really do anything with it and be successful.
Yeah, you said the right words, which is conservative. That's the thing that people need to put that hat back on, because for the last 3-4 years, people were running with, oh yeah, I'll just buy it now. No matter what, in next year, the price will be up. The price will be up. The price will be up. Yeah. Not remembering like the fundamental piece of investing is the purchase. The initial way you buy it is how you're going to set yourself up on the back end. And if you're not doing that in a conservative way, you could lose your ass. Definitely in a time and a world that we're living in now where stuff can just change in the blink of an eye.
I think being nimble is super important. I know us as fix and flippers, our goal is to get in and out very quickly. So if the market changes, we can really shift in and out of the whatever market gives us at that moment. Whereas the iBuyers like Open Door and Zillow, I mean, you saw Zillow stop their whole buying
collapsed.
program and actually brought Open Door to come in and replace them within the Zillow platform. Yeah. And now you're seeing Open Door taking huge haircuts in many markets, and I don't know what's going to happen with them, but it's definitely a tough scenario for them.
Yeah,
they couldn't pivot.
The iBuyer program went from, because what was so crazy when the iBuyer program stepped in at first, they were even buying luxury properties. They were buying any and anything because, again, they came in, too. Yes, and thought this was like a market that was going to be around. They built an entire business model around appreciating real estate. Yeah. And like that just doesn't exist. Like it does for a long period of time, but when you're in a company that's that big, the market, just like it has right now, in 60 days is a whole different market. And if you thought you were going to pay for that house at $1 million and then sell it for 1.5, and now it's only worth 800 and it's sitting on your books and you got 20 of them, it's a problem for the company because you have all these employees that you have to pay. And now your interest rates on the purchases are more, and now you've had to lay people off. So now you can't get the new properties in the door to subsidize the loss. It just creates this cycle where you can lose your ass very, very quickly. And these are companies, like we're individuals or small teams doing these. These are companies with millions and billions of dollars doing this stuff, and they're losing their ass. Like that's how big this problem could get if you are not wise, conservative, and think you're just going to ride the market and don't actually have a team that knows what they're doing. And real estate is so local. Like this is not a big macro thing where you can judge it. There are those numbers that exist, don't get me wrong, but when you're truly in the market and understand, that pocket, no matter what the market's doing, I'm going to buy that one, you can make money. But if you're only looking at it from a top level, do you know what you do? I'm going to cut my margin. I'm going to cut the price, which is what they did. I'm not buying luxury anymore. I'm going to buy $500,000 houses. Oh yeah, we're not spending 500. Our cap is 460. And now you're buying crappier and crappier product just to fulfill the investor on the back end's needs to keep cycling their money and making deals. And then you end up with what happened. Big banks went bankrupt in the last recession because they were trying to do things like this, take on mortgages that were really crappy mortgages, but they had investor needs on the back end. So you have to be able to really manage that and budget that yourself and know your market that you're buying in.
Agreed. No, I love that. I remember in 2008, I don't know if you recall, but there was pockets, you speaking about localized real estate, there was pockets in the Denver community where they had a 50% depreciation within 6 months. Yep. Green Valley Ranch, certain areas like that. Yeah. I don't see that happening this time. I think ultimately, you're right, it is localized, and there are pockets that will be able to ride this wave of depreciation over the next 6 months to a year, but I don't think you're going to see it nationally or even locally here, that there's going to be markets that are taking a 50% discount.
No, definitely not. What's so crazy about the market right now and what makes it so weird is, so on the transaction side of things, in the last 60 days I have had a house where it has had price reductions for the last 60 days. And then I had another house that had 5 offers on it in the same real estate market because of how local it is. That house is in a primo location. It had trail access out the back of it. And that's what people are coming to Colorado, because people are saying to themselves, okay, if I'm going to pay this high interest rate today, I want something that's worth it on paper, right? They're looking for more value. And they don't want the fixer-upper now, whereas, like we said, in the COVID time and the lockdown, it was like, I just need a house. Any house, I'll buy it. And that's what 15, 20 people were saying, and pushed the prices up, and they had to stay in their homes. Whereas now they're like, no, rent is up, my mortgage is up. Even if I could do either or, and I'm paying a hefty price, so I'll just wait and get the right one for me, and that can create a whole market in itself, which is happening.
And that's a really great point, because we, as fix and flippers, that was a mistake that we made starting off, is that if the property worked out on paper, that we thought it was a good investment, right? But there is so much subjective analysis that needs to go into a property that we are so selective now with our fix and flips, with our rentals, with our short-term rentals. We're very selective because we focus not just on paper. That's the first thing we do, right? We say, okay, yeah, this checks out. It checks the boxes. It meets our criteria for the investment. But now let's go see that property, because I want to make sure that I can walk into this property and say, oh, this is a great one. You know, this stands out. This has unique characteristics. It has vaulted ceilings. It has nice wood carpentry throughout. It backs to a trail. It has subjective factors that these other comps, even in the same neighborhood, don't have. Therefore, I'm confident that if I have to sell this property, even in a down market, this one is still going to be far more competitive.
And I'm sure even in the Airbnb stuff, that's probably the same. It's the same analysis, right?
Even more so.
Even more, right? Yeah. Because people want to have like fun, because this is a trip. They want to do stuff where it's like, I need to look at this, and there's no way you can just look at this on pen and paper and be like, this house is going to be a fun house. How do you calculate that without knowing the neighborhood, without knowing the house, without knowing what people want to do in that area? You have to be able to know the localization of the market.
100%. You know, with short-term rentals, like I said, it's 100 times even more, because people are coming here for vacation many times. And so you want to be close to access to highways. You want to be close to shopping. You want to make sure that the house is its own destination. So a lot of people, for short-term rentals, they'll come in and put old furniture, or they'll just move and leave their old furniture there. They'll take pictures with their iPhone. And then when people are searching on, you know, Airbnb or VRBO, they're seeing a house that has, you know, crappy stuff in it, right? Where, you know, if you want to maximize your short-term rentals, you make it a destination in itself. You put a pool table, you put a hot tub in the back, you make it something really nice that people want to come to when they're on vacation, that they can enjoy with their friends or family.
Exactly. And all of those things reign true. That's actually how the luxury market is working right now. So in luxury real estate, people don't have to spend $8 million on a house. No, there's no person in this world that's like, I really need an $8 million house today. No, they have to buy it for a reason. It's got to be because this is going to check some boxes for my family or my lifestyle or the destination that really is going to make me pull the trigger and make me want this property. And if it's just this house is clean, nice, and built well, that's not enough. That's not enough. Is it walk-in? Does it have a sauna? Does it have a cold plunge pool? Does it have all of these cool amenities that make it like, yes, I want to spend $8 million on that property? Because if I have to stay in this house, or if I have friends over, there's a whole lifestyle that comes with the house, and not just a house with four walls. That's why you're seeing so many like luxury builders build outside of the box kind of homes right now. They've really focused on amenities in a property. Pools, gyms, hot tub, cold plunge, all of those things are being incorporated into homes right now, whereas that wasn't a thing in the past before.
Are you seeing the compression in pricing on the luxury market as you do in the mid-market? For instance, you know, we're seeing all these properties that are selling for $80,000 to $100,000 or less. You know, I've heard people talk like, well, rich people, you know, they're paying cash many times. They're not so rate sensitive. So, you know, is the pricing reflective of that?
Yeah. It's funny when people say like, oh, because they're not getting a loan, like they don't care. They'll just pay. It's like, no, this person has a $50 million net worth. Like they understand
for a reason.
They understand what rate increase means. And it may not mean that they're using the rate or not paying in cash, but it's affecting their portfolio, or it's affecting their decision making, because they're savvy enough to know if rates are going up and there's pressure happening for people that are paying with a mortgage, my value in what I'm purchasing is going to be affected in that as well. So instead of 8, if I can get, like, that person is actually going to benefit more by paying cash, meaning if the prices are coming down, this is liquid cash they're using. If instead of liquid 8 million, I can get it for 6, they are actually going to save $2 million. That savvy person wants to save $2 million bucks. Right. Like they want to do that. So yes, it's affected the actual sellers, so the supply, meaning you're seeing luxury homes come down in price. You're seeing price reductions in those areas, because now you have to give even more incentive to somebody who's coming in and paying 7 million. Your house was worth 10. Well, I'll pay 7. And that seller is like, last year I could have got 10. Well, now you can't anymore, right? That was all just based on supply and demand for that window of time. Now the supply is going up, right? There was so much new construction in Denver. For years, the like 2.5 to 3 million was like this obsolete, like weird zone and pocket in real estate where nothing good existed. All the developers came in, bought the lots, and started building these 2.7, now 3 million to 3.5 houses. Next year, those are all going to come to market. There's going to be a massive supply of 2.5 to 3.2 houses in all the coolest neighborhoods.
Yeah.
They're going to have to take haircuts on those prices because buyers are going to be like, well, there's 15 for me to choose from now because you guys bought all of them and built them all. So they're slowly trickling onto the market now. So even in the luxury space, rates, market, it all is a factor. It's not that people will pay cash and it doesn't affect them. No way.
Yeah.
I'm curious, just because you have had such an extensive experience in real estate. You said you started off with short sales and in 2008, which was one of the toughest markets. Then you've been through the highest market that we've probably ever been in with insane appreciation. It seems like you've shifted your strategy and now you're one of the best known luxury agents in Denver. So with that wide range of experience from, short sales to super high-end luxury properties, how has your investment strategy changed with that experience, and what is your strategy going forward?
Wow, that's a good question. And a lot of this, they're asking me this question because they know they give me all the good tips themselves on how to shift and stay alert. But no, personally, I like when we were leading up to where we are today. I almost pulled the trigger on many deals. Prior to this, let's just go back a second. So right before the market ticked up, I bought a duplex in Inglewood, which was a great buy at the time. And then moving forward from there, I was keeping my eye out for deals. And the thing is when you're a real estate agent, the spread has to actually be even greater, because it's like I can give this deal to a developer. I can get a commission on the purchase. I can get a commission on the resale. So I have to bake that cash on my risk level. And I'm a risky person. So to take that risk and take that cash off the table, it's hard for me to buy investment properties, honestly, or flips or development opportunities, because it's like I can get this money, but I have to look at the long-term picture of things. So going in, it's like I did one. It was a super slam dunk deal. I was like buying it no matter what. Now moving forward, I have to analyze deals on how the market is going to be 6 months from now. That's how I'm actually analyzing. Like you're going back 1 year. I'm going forward 6 months and stacking cash today so that when there is developers and flippers and everyone, like you guys said, not being conservative, there's going to be, it's sad to talk on this subject, but there will be like serious situations that come out of this, meaning bankruptcies, people losing their properties, because yes, there's been this massive run of appreciation, but there's also been this massive run of acquisitions even in this last year.
Absolutely.
And people didn't do their correct analysis and didn't be conservative on their purchases through this just last run. And next year, when they get that build costs and now the new mortgage rates and now the inflation and everything, they're going to say, wow, this deal is not a deal anymore. And I'll buy those deals. Those are the deals that I'm looking to buy. When this guy says, this doesn't work for me, I need to get out of the deal. But the sad thing is, there's going to be 20 of those people. And those 20 people will all have to get out of the deal. And there may only be 10 of us around at that time because half of the people are getting out of the business because they couldn't survive and they weren't conservative. So now those 20 people only have 10 buyers. So we can now dictate what those prices are going to look like from our end of it and get real 50% discounts and 30% discounts on an already depreciated market. So that's how I'm going to kind of go into this. It's like for the next 90 days, stack cash, see what happens, be smart, don't go spending, forget buying shoes and bags and going out for dinner every week. It's like, just chill out for a moment, relax. Like, we had a good time, now let's chill and see how this thing unfolds, and prepare as much as you can to strike. And again, it could happen 3 months from now. It could all change. Market could be, and maybe it's time to strike then, and I'll be ready. I've got all my investment properties I have my HELOCs. I put the cash there. The cash is just sitting there, ready to deploy at any moment in time that I see the deals come out and poke their heads out. I'm ready to buy them. So it's like, that's what investors should be doing now. If they have investment, HELOCs, I don't know how much you talk to your listeners about it, but it's like, that money can sit there. You don't have to make a payment on it. So it's of no risk for you to pull that money and just have it sitting there.
Just have a line of credit.
Just have a line of credit. Yeah. So, and it's your own line of credit. You can move around. Make sure you're aware on those lines of credit what kind of stipulations are for the bank to pull them too, and ask those questions. Because just going through the last recession, I remember people had lines of credits. When the value on the house went down, all of a sudden the lines were going down as well. So know what's happening with those lines of credits. And worst case scenario, if you do have a line of credit where the line can get pulled, take the cash, put it in a bank, and just pay the payment with that same cash. And then if you find a deal, you can put the cash back, do whatever you need to do to move the money around.
Right, because if you don't utilize it and they shut it down, there goes your liquid ability to be nimble in this market. So absolutely.
Yeah,
great.
2008, my credit cards, my lines of credit, everything.
Evaporate.
My credit cards.
Yeah.
If I didn't have it maxed out, they're like, you owe 5,000, your max line is now 5,000.
Yep.
Like, it was insane, the stop that they put on credit back then.
And I don't think people know that can even happen. Like, what's funny about this go around is there's a lot of people in the marketplace right now who have never gone through a recession before.
Right.
There's a bunch of 30-year-olds that were babies when this happened, and they don't even understand like those quick movements that can, where you think my line is 100 grand and now it's 2,000. My credit card, I got a 50,000 limit. It's 5 grand. Like they don't know that can change. My job, my company, closed down. All of a sudden, they thought they had the best job in the world, and the company's like, no, behind the scenes, we were struggling this whole time, and we didn't tell you, and now you don't have a job anymore. Like, people have been chilling at home, saying, I'm not gonna go to work because I just want to get, the best job, get paid the most. When it changes and you can't get a job, and now there's 50 people going for the job, and you aren't able to get a job anymore, because that's why it was in 2008. There wasn't anyone hiring, and there was 50 people trying to get one job. Like, that mindset hasn't ever kicked in for this generation yet. And they are going to have a rude awakening when they face that kind of hurdle to overcome.
Which is, I mean, it's not funny, but it is in a way, because, we've been hiring for the past 5 years, really. And it is a generational thing. The older generation knows work ethic and knows how to work really hard. And the younger generation, they are all about, in the amount of interviews we did, work-life balance was, the number one thing they brought up.
If I hear that one more time in an interview.
Which we support.
Because they can just get famous and rich on TikTok. They don't need your job, bro.
Yeah.
Good to go. They're good. And the thing, this is what people have to understand. It's like, making it rich and famous on social media and YouTube and TikTok and all, like, this is like a 0.05% chance that, like, compared to the amount of people that are on social platforms, the people that are making a decent level of income, this is like being a professional athlete. Like, that's the level of success or work you need to put in to get to their stage. And people think, I just need to make that one video that goes viral, and then boom, I'm going to be the star of the show. But like, all of this kind of mindset stuff is how you have to kind of recalibrate how you're thinking. You have to today you should be thinking like right now for me, I'm thinking like Delroy in 2008. That's the hat I have on. Like every deal, wherever it is, I'm going and doing it. I'm not comfortable right now at all. Uncomfortable, moving, shaking, wheeling, dealing, trying to make anything happen. And I'm not broke, but it's like, that's the mindset. I'm going in where like...
And you're thinking 6 months from now.
6 months.
And these people need to be thinking 6 months from now, where are they going to be? If the market's tight, if there's opportunities, you need to be positioning yourself now. Right?
Absolutely. Because, Warren Buffett says it the best, but when everybody else is fearful is when you can make the most money.
Yep.
So if you're setting yourself up, like you said right now, to be liquid when there's tons of opportunity, that's where you can make it, and not just make it as an investor, but make it big. And essentially, hopefully, retire and have financial freedom, which is what we're all seeking to do.
Financial freedom. For sure. Definitely. Yeah, it's the thing is it will all kick in for people when like here's the thing is the government literally said that for the inflation and for things to change, people have to lose their jobs. Like this is the government literally telling you that we're gonna squeeze you until you lose your job. Like they're not joking. Like this is not a joke that they're just saying this for fun. Like they're actually going to put things in place. Like they have been raising interest rates, doing all these things so that the economy slows down, so the prices don't keep going up. But people aren't acting like that's what's happening. So what will happen is 6 months from now, when the government applies their pressure so much so that you feel like, oh man, I can't get a job, or oh man, I don't have the money to go and do that restaurant. At that point, when the general population feels that way, when they actually truly sit in there thinking, wow, it's tight, my money's tight, we shouldn't do that, let's chill out, let's not do this spending, let's not do all that. At that point in time is when the rate will probably start alleviating itself and coming down a bit, because the government's like, okay, we got them. Now they're actually chilling. They're actually chilling. The rate's going down. And then those people will be stuck, just like they are right now, in that fear mindset of, I'm going to hold on to every penny and not go and buy the opportunity. That's why the opportunities exist. It's because it's all like a fear factor of, no one listened to the pre-warning that this podcast or people have been given for months now. It's like, start early so you can be ready. People are going to spend all the way up until the day that now you only have $10 in the bank. Your credit line just got decreased. You just bought the boat yesterday and you're like, shit. I need to sell the boat. Now no one wants to buy the boat. No one wants to buy the boat. Who wants a boat for $100,000 when they can't even get a job? So now you're selling your boat for $25,000 and Delroy is going to buy it for $25,000. Right. That's the problem. Like you have to start early and be ready. Otherwise, like you said, Warren Buffett will look at this and be buying up shop, and everyone else will miss out on the opportunities.
No, I agree. So I guess, we have to wrap this up, but I just want to ask one last question. So as we go through this tumultuous time, we know that the market, is going down. Where do you want to be in 1 year? Where do you want to be in 5 years? What goals have you set out for yourself? And are you a goal-oriented person? Is that how you achieve your goals, is by having that vision first and then trying to get there? What does that look like for you?
Goals, huge part. Goal setting in general. I'm a visionary person, so I have like my vision in my mind. But then I've been trained and learned that over time, getting it out of your mind onto paper, everything has a date, everything has a price, and you just narrow it, and then you go from the dates, the price, the activities, and now you have your daily tasks to do, and that's how you'll achieve the goals. So for me right now, definitely in a year, I want to build and do development, build a luxury spec home, my design, my vision, and get more into the development space for myself. And then want to continue. Our team does about 100 million in sales volume for real estate right now. Our goal is to just keep that consistent. That is enough to sustain us, even if we take a little dip through this moment. But we're focused on just keeping that number, staying nimble, and just having the best systems in place with a small team. And then from there, it's like, what other investment opportunities will present themselves? It's like we have to just stockpile that cash, find the development deals when they come into fruition, and then just try and pay off anything like my investment properties, get them paid down, like double down on some payment stuff, things like that. I don't carry much debt in general, except for like real estate, like business debt. And then, yeah, I think if we can just stick to that, we'll be good. And that's the thing that I would tell everyone is like, in times like this, you actually don't want to start adding on a ton of things to your plate. It's like just get more and more focused on a couple of things. If you're in a short-term rental investor, just double down on that. If you're a fix and flipper, tweak the numbers and double down on that. And like for me, I'm in luxury. I'm going to double down on that and get into development. Those are my two things that I'll get into. But if I see along my way, because I'm in real estate, deals present themselves. So if I see Mike's like, hey man, this short term, this is the one, you should get this. Or we partner, or, again, people should collaborate in partnerships too. I'm all about doing that type of stuff. So if we find a deal, boom, we can take less risk in the deal, go for it as well. And that's what people have to remember. What is your risk tolerance? Everyone needs to know, where are they comfortable? I was in an investment group before, and we all put, I can't even remember, this was early in my career, and I think we all put like 10 G's in the group, and we were buying properties in Detroit. And it would have been great, especially back then based on the appreciation, but one of the partners in the group had already bought a property down there for like, I think it was like 13,000. And now the property is worth like 300,000. When they bought it for 13,000, there was land lots next door to the house. And if you purchased the house, which our investor in the group did, you could buy the lots next door for $100, and you could just keep buying all the way. We could have bought the whole block for like 4 G's, right? We had a meeting. I walked into that meeting. I started the meeting saying, hey, I have a pretty high risk. Like if we're going to do a whole analysis on like $100, $4,000 purchase, this group's probably not for me. There were people in the group that were like, no, we need to run the numbers, make sure this is a wise decision. I had to bail out of the group. So everyone needs to know what's your tolerance. Surround yourself with people that are maybe a little less aggressive than wherever you are, so you can get those, or just speak to people who are less aggressive than yours. Always figure out what the worst case scenario is. But if you're okay with the worst scenario, go for it. That's it. Like, put your bar the highest risk, figure out what the worst case scenario is, and just do deals within that box.
Love that.
Right there.
Yeah.
And you'll be good to go.
I love that. Yeah, absolutely. I think ultimately, we tell people all the time, if you're not taking those risks, you're not getting wealthy. You have to take risks to get wealthy. We need everybody on this planet, right? There's people that need to be in corporate America. There's people that need to work at McDonald's. I love McDonald's. I need those people, right? But ultimately, unless those people are willing to take the risk to say, hey, I'm going to move up in my position. I'm going to take that job that's offered to me. Yep. I'm feeling uncomfortable. You talked about being uncomfortable earlier. You have to be uncomfortable. When you get uncomfortable, you try harder. You do better, right? Yep. You succeed more. And I think ultimately that's a huge thing, is people need to take those risks.
Yep, absolutely,
yep.
man.
Delroy,
Thank you for having me, bro.
Thanks for being on. That went by so fast, man. That was a great conversation. It's always a good time, man. Thanks for coming on board, and we'll see you next time.
Sweet.
All right, buddy.